Hi all, welcome to this session. In this today discussion, we are going to discuss about the assets. In the previous session, we already started with the balance sheet and now we are moving into assets. Asset is one of the key component in the balance sheet where if you remember the previous session, we already discussed about the accounting equation as well that is applicable in the balance sheet. That is asset is equal to total liabilities plus total capital or total equity. So assets mean those are the financial resources owned by a company. So the key learning objectives of today's discussion is define and classify asset into current and non-current assets. There are two key categories of asset, that is current asset and non-current asset. Current asset mean those assets which can convert it into cash within 1 year, and non-current asset are those assets which are not expecting to convert into cash within 1 year. Then apply the asset measurement principle like based on cost, based on net realizable value and the depreciation. Then understand key asset categories tested in the CMA exam and perform basic calculation, net realizable value and inventory valuations, and identify common exam trap and errors. So this is the key learning objectives for today's discussion. So let's get started. Before moving into asset, what is an asset? We know there are a lot of assets are there like plant and machinery, equipment, account receivable, cash, all these are the assets. So what is the definition of an asset? It's a financial resources. Definitely it should be a financial resources and it's controlled by the entity. It should be under the control of the company and resulting from the past event. It should be a result from a past event and expected to provide future economic benefit. So it's a financial resource controlled by the entity and it is resulting from a past event and also it is expected to provide some future economic benefit. And also the future economic benefit is probable and value can be reliably measurable. These are the conditions to clarify or to satisfy an asset. Suppose if a company have a well-skilled employees, is this an asset? No, because it is not controlled by the entity. So to meet the requirement of the asset or to classify one resource as asset, you have to satisfy all these conditions. And for the recognition also it should be future economic value should be probable and value can be reliably measurable also. So this is the characteristics of an asset. Now let's move into classification of asset. Classification of asset, it's the key classification is the current asset and non-current asset. Current asset mean those assets which are expected to convert into cash within 1 year or less than 1 year. And non-current asset are those assets which are not expected to convert into cash within 1 year. The purpose of current asset is to finance the operating cycle or day-to-day activities, and the non-current asset mainly for long-term use. The liquidity is high for current asset and low for non-current asset. When it's come to liquidity, if the current asset like receivable and inventory we can convert into cash very quickly than non-current asset. If you look into a case of a non-current asset like plant and machinery or equipment which is difficult to convert into cash. So in case of liquidity, the current asset have higher liquidity compared to non-current asset. So here you can see some examples of current and non-current asset. The key current asset is cash, account receivable, inventory, those are under the current asset, and non-current asset property, plant and equipment, intangibles and long-term investment. These are the non-current asset or long-term asset. So here one of the key important thing why classify current and non-current assets. If a company's operating cycle is more than 1 year, suppose if a company is producing a big machinery or a big equipment, in some cases the operating cycle may be more than 1 year. In these cases, we are considering the operating cycle not a 1 year to classify current and non-current asset. Let me clarify this. So to classify a asset as current asset, first it has to be converted into, it can be converted into cash within 1 year or within one operating cycle, whichever is longer. Suppose a company's operating cycle is 1.5 years, then in this case the current assets are those assets which are expected to convert into cash within 1.5 years or within one operating cycle. Now measurement base of asset. How we are measuring the value of an asset? There are different methods for different asset to value for the measurement. Suppose for the property, plant and equipment, how we are measuring is based on the historical cost. What is the historical cost of that asset, or how much we spend on that asset, that is the value of that asset. When it comes to receivables and inventory, it is net realizable value. That means net realizable value is the measurable method in receivables and inventory. When it comes to some investment, if a company have a investment in the market, so it can be based on the fair market value. So there are some different methods to measure the measurement of asset or measure the value of the asset. It is based on the different assets. There is a different base for different asset, like property, plant and equipment. It is historical base. How much we spend on that total asset, that should be for property, plant and equipment. Then the receivables and inventory, the cost or net realizable value, whatever is lesser, that is the realizable value. And for the investment, it is a fair market value. So these are the some measurement base for assets based on the asset categories. Then key asset categories. The first category is cash and cash equivalent. Cash and cash equivalent is those assets which is the key item included is first one, cash in hand, bank balances and short-term investment which can convert it into cash within 3 months. So these are the cash and cash equivalents. If there are any restricted cash in the balance which is not included in the cash and cash equivalent, and is the long-term deposit also not considered as a cash and cash equivalent because its liquidity is higher than cash and cash equivalents. So the next category is accounts receivable. What is an account receivable? If you sell a goods to a company for a credit, there you will create an account receivable. That means that company or that value is an account receivable for you. And also when it comes to account receivable, there is a risk associated with account receivable. Suppose you sell a goods for 100,000 for different customers. In normal cases, we cannot expect that we will collect all this money from the customers. So there is a risk associated with or a cost associated with account receivable. So in this case, what we will do, we create a provision or we'll create an allowance for account receivable based on the company standard. Suppose if a company created an allowance for account receivable, the net realizable value will be 100,000. Suppose we created allowance for as 5,000. So in this case, the net realizable value will be 100,000 minus 5,000, that is 95,000 will be the net realizable value. So for the account receivable, the net realizable value will be total account receivable minus the allowance. You have to deduct the allowance from the account receivables. Then the inventory. Inventory is one of the key component in the balance sheet in the current asset, where in most of the companies it is a considerable value aspect. So the valuation method, how we are valuing the inventory. Suppose you purchased some inventory on a particular price, then the price got changed, and again you purchased it with a different price. In this case, how you will value the inventory? This is a consideration. So there are some assumptions in valuing this inventory in this case. First assumption is FIFO. FIFO means first in, first out. So in this case, we are assuming that we are selling the first purchased item first. If you have a multiple layer of inventory. That means you purchased it on the beginning of the year, mid of the year, end of the year. So if you sell the first item, you are considering for your sales, you are considering that the first purchased item is selling first. Then the weighted average. Weighted average means it is averaging out total cost. Suppose you purchased some material for $10 and you purchased some material for $20. In this case, you are averaging the total inventory cost and you are allocating it to each product unit. So the each product cost will be the mid of these two prices. 10, or if you purchased some for 10 and some for 11 or 12, so your average cost will be mid of this. Then the LIFO. LIFO means last in first out method. Here you assume that you are selling the last purchased item, you are selling first. So why this valuation method is relevant? It is to calculate the cost of goods sold. Cost of goods sold and the gross profit. Just look into this case. If a company purchased 100 units at $10 and 100 units at $12, and the company sold 100 units. So in the FIFO, we are considering the cost of this sold is 100 into 10. This is your cost of sale in the FIFO. In the weighted average, it will be 100 into 11. That means you have to average these two. In the LIFO, last in first out, it will be 100 into 12. So this is the difference between the FIFO, weighted average, and LIFO. Let's move into next category of asset, that is property, plant and equipment. Property, plant and equipment initially is measuring in historical cost. Historical cost means how much the total cost to develop that property, plant and equipment. Then we are allocating a depreciation over its useful life. Suppose if a company spent 50,000 to develop a plant or an equipment, and it is considering a residual value. Residual value means the value exists after its life, it will be 5,000, and the life of asset is estimated as 5 years. So in this case, the depreciation will be 50,000 minus 5,000, that is 45,000 divided by 5, that is 9,000 will be yearly depreciation. So this value we will reduce by year to year, and we are considering this depreciation as an expense in the profit and loss account. So when it's come to property, plant and equipment, the initial assessment will be based on the historical cost, and again the depreciation is affecting or depreciation is considering based on its total residual value and expected useful life, and depreciation has to be reduced from the total historical cost to calculate the net property, plant and equipment or net fixed asset. Then let's move into intangible assets. Intangible asset means those assets which we cannot touch and see. Like a company have patent, trademark, goodwill, all these come under the intangible asset. The treatment for intangible asset, if there is a finite life, we know the exact lifetime for the intangible asset. In this case, you can amortize it into each year. Is there anything with indefinite? We don't know exact life period of that asset. In this case, we are not amortizing. It will test for impairment. Again, one important thing is goodwill is an asset which is not amortized. So this is an exam tip for you. So let's have a quick summary of comparison summary of the key asset what we discussed. The first thing is account receivable. First asset is account receivable. Based on the net realizable value we are measuring, and the key rule is allowance has to be deducted from the total to calculate the net account receivable. Then the inventory is lower of cost or net realizable value. In the inventory valuation we are considering as a conservative approach. Then the property, plant and equipment, that is the key fixed asset, that is based on the historical cost, measurement based on the historical cost, and its depreciation has to be applied over its useful life. Then the intangible asset like a patent, trademark or goodwill, the measurement based on the total big cost, and it has to be amortized if it have finite life. And if it is not a finite life, we don't know the finite life. Again, it is in infinite life, it no need to amortize. This is a quick summary of the total assets what we discussed. Then let's have a quick a simple case scenario for a better understanding. So in this case, you can see the total account receivable is 80,000 and allowance is 8,000. Inventory cost is 50,000. For the inventory, the net realizable value is 45,000 and the property, plant and equipment is 100,000. So you have to calculate the total assets. Here you can see the account receivable. Account receivable is total value is 80,000, but there is a allowance of 8,000. So to calculate the net account receivable value, you have to reduce the allowance from the total account receivables. So the value of total account receivable is 72,000. Then let's come to inventory. The inventory cost is for 50,000 and the net realizable value is 45,000. So the inventory valuation normally you have to consider the lower of inventory or net realizable value. So here it is 45,000. When the property, plant and equipment, we have to take the direct number. It is 100,000. There is no any treatment is indicated here. So the total value of the asset is 72,000 plus 45,000 plus 100,000, that is 217,000 is the total value. So here the key consideration is for the account receivable, you have to reduce the allowance, and for the inventory cost, you have to take only the lower of cost or the net realizable value. Based on this principle, you have to consider the value of inventory cost. So let's move into multiple choice practice questions. Which asset is measured at a net realizable value? Property, plant and equipment, inventory, account receivable and cash. Here it is the account receivable. Question 3. Question 2. Inventory cost is 60,000 and net realizable value is 55,000. What is reported value? For the inventory, the lower of cost or net realizable value will be the reported value. So in this case, it is 55,000. A company has account receivable 120,000 and allowance is 10%. What is the net realizable value? It is 108,000. That means you have to reduce the 120 from 120,000. You have to reduce the allowance 12,000 to calculate the net realizable value. That is 108,000. Then why inventory is valued at the lower of cost or net realizable value? This is to follow the conservatism principle. Conservatism, there is a principle in the accounting, that is conservatism. We have to consider, while valuing an asset, we have to take only the conservative approach, which ensure that assets are not overstated. So just a quick summary before winding up. There is a quick summary. What we discussed today is all about the assets. That means are the resources with future expected benefit. That are the asset. And we are classify the assets into current and non-current. Current asset mean those assets which are expected to convert into cash within 1 year. And non-current asset mean those assets which are not expected to convert into cash within 1 year. And then current asset mean those are the short-term asset, and non-current asset mean those are long-term assets. Then the key measurement for the account receivable, it is net realizable value. For the inventory, it is lower of cost or net realizable value. For the property, plant and equipment, it is depreciation has to be deducted from the total cost. Then the important exam areas: allowance for doubtful accounts, then the inventory valuation method like depreciation, FIFO, LIFO, and weighted average. Then the depreciation while it's come to property, plant and equipment. So this is about today's discussion. If you have any doubt or you need any clarification on any of these topics, please ask me on the comment section. Thank you for watching this video.